So you've just heard about a bank rate announcement that has dropped from, let's say, 4% to 3.5%, and you wonder, how can I get access to this 3.5%? Let's take a look. So when there is announcements on the Bank of Canada reducing their target interest rate from 4% to 3.5%, or 5 to 4, or 5 to 4.75, that is the bank rate. And the bank rate is not something that you and me can borrow from at that rate. That is the rate at which commercial banks can borrow from the central bank at the overnight interest rate market. And in there's two different rates that we have to keep in mind. In the past, there was 3, but now in Canada, there is 2. And I'll just explain rapidly what it used to be, but I'll cut back really rapidly to where it's going now. Who knows if it will ever come back to what it used to be. Essentially, there is a target for the overnight rate. So let's just understand this for now. So the target, let's say it's 3%. We want the overnight interest rate to be 3%. So then afterwards, there is a price below, an interest rate below, and an interest rate above. And the interest rate below was the rate at which you could lend to the Bank of Canada. So let's say 2.75. And the rate above was, let's say 3.25, was the rate at which a commercial bank could borrow from the Bank of Canada. Naturally, you can, as a commercial bank, you could lend at a lower rate than you can borrow. So it's not as if you could so it's not as if you can borrow and lend at the same rate, or borrow at a lower rate and lend at a higher rate, or else you'd just do that over and over again. Naturally, the higher the rate is the one that you borrow at, the lower rate is the one that you lend at. And the idea behind this was that if you have a lot of banks that are in this overnight market, and there's some of them that have money that they need to borrow, and some of them have extra money that they can lend, the bank doesn't necessarily want everyone to deal with the Bank of Canada. And in fact, these commercial banks have a higher interest in meeting between each other and borrowing and lending to one another. How does this work? Well, in the example I just gave you, let's say you needed to borrow as a bank, you borrow at 3.25, and this other bank is lending at 2.75. Well, if they can get a greater return than 2.75, that bank's going to be happier. If they can lend that money to someone else at more than 2.75, good. And this person that's borrowing, if they can borrow at a rate lower than 3.25, also good. So what this process led to is, if there's an equal amount of people are willing to borrow and lend in the overnight market, well, it leads to a rate that's very close to the midpoint, which is often known as the target interest rate in the overnight market. And that target rate is often in a situation where commercial banks don't deal with one another. They deal with one another, rather. They don't deal with the Bank of Canada. So in fact, even though the Bank of Canada is the one that set these rates, that set this kind of range that's acceptable for the time being, they're not necessarily taking part in this borrowing and lending process. So in this story here, 3.25 is the upper rate, 2.75 was the lower one, and then the midpoint, the target, was 3%. And most banks would trade with each other at 3%. So whoever needs to borrow would pay 3%, and the person that's lending would receive 3%, which is better for them than borrowing at a higher rate and lending at a lower rate. These days, though, they reduced the band. So what they've done is they've removed the bottom portion, and the target is also the lending rate. So if you want to lend to the central bank, you can lend it at that target. So let's say we keep the same target of 3%, and now the bank rate is still 0.25 higher, so it's 3.25, and it's just that everything happens within that. There's going to be no rate that's going to be below, because if you have money to lend, you're not going to lend to someone else at 2.9 when you could lend to the Bank of Canada at 3. They're trying to just reduce the size of this band. There's no set regulations on the width of it. It used to be a 0.5% band and the midpoint was the target. Now it's a 0.25% band and the lower part is the target and the upper part is if you can't deal with one another in the overnight market, this is the rate at which you will borrow from the Bank of Canada. The impact here, the goal of the Bank of Canada is not to emit loans and to borrow and pay for savings of the commercial banks. It's really just to direct the interest rates in the economy, because once they have an influence on this rate, it has an influence on the other rates in the economy. Because if a commercial bank can borrow at 2% instead of borrowing at 5% from other banks or from the central bank, it means that it could also loan out its deposits at lower rates. So mortgages will be cheaper, other line of credits, other variable interest rates will all be cheaper if the bank rate is cheaper. Okay. So by having influence on this rate, it has an influence on all the other ones as well. And then when it wants to kind of contract the economy, well, the bank rate, this kind of range that's acceptable, is just they're just going to increase it. When they increase it, they increase the lower and the upper band, and it's just kind of moving up. So it could have gone from 3 and 3.25, and we really have to slow down the economy fast, so it goes up to 4 and 4.25. Well, it means that these commercial banks that were used to being able to borrow between 3 and 3.25% overnight now have to pay between 4 and 4.25. Therefore, they're going to try to keep more reserves, and they're going to make sure that if they make out loans, that they're getting a good return on those loans to make sure that if they run out of money in the overnight market, they have at least high-paying loans to compensate for that. So this kind of process of increasing and decreasing the overnight rate is to guide the economy. And the way it works is it's offering limits to what commercial banks would have to pay if they run low on reserves in the overnight market. And the idea by setting this limit is that it removes kind of massive uncertainties or volatility in how much people can charge. Because imagine if the central bank did not exist and you're a bunch of banks, and for some reason one bank owes another bank a lot of money at the end of the day and they have to settle their differences and they simply cannot pay. If one night they've been used to charging 2% and one night the other bank was like, no, you don't have the money to pay me, 12% is going to be the interest rate. Well, it'd be a big surprise, and it would mean that this bank would go like, well, that's not what I expected. I would have acted differently if I knew. So by having this kind of range that works, it removes that volatility, that uncertainty that can happen even in the overnight market. So it's just kind of setting a limit, and it just makes sure that the banks can make good, sound financial decisions in terms of how much reserves they keep and at what rate they charge for their loans based on how much they know they're going to have to pay for the next month and a half. It removes all of that volatility that could happen if it wasn't for the central bank being in the overnight market. And just to make sure that this is clear, why certain banks may owe other banks money at the end of the day. Well, let's say you buy a house and you're with Bank of Montreal, and the person you're buying a house from is with TD, and you need to pay for that house. Well, you're getting a loan with this bank. Well, this bank, when you're going to the notary, has to transfer money to the other bank because his bank account, the person you're buying from, wants to get that money. Well, that money needs to get transferred, and often you'll just sign a piece of paper and be done with it, but they have to balance their books at the end of the day. Same thing as if you need some cash and you go to an ATM machine and you're with a certain bank and you decide to go to an ATM machine of another bank. Well, the amount's going down in your bank slip and the amount is coming into your hands, but that bank needs to settle its differences with the other bank by the end of the day. And if it can't, well, that's where it deals with the overnight rate and it borrows from another bank or from the Bank of Canada. So that's the most short-term interest rate because it just happens overnight. It's just this one moment kind of thing. It's not like a year-long rate, and that rate trickles down in the economy through all the other rates, and that's how you could understand. So as a bank rate goes up or down, we know it's going to have an impact on everything else, and that bank rate is only focused on commercial banks. So hopefully you could understand that the bank rate, you will never have access to the bank rate that is in effect at the moment being. And then your bank rate's always going to be your prime rate, we can say, with your bank account, will always be superior to that. To what extent is your rate greater? That all depends on creditworthiness and a bunch of other factors, but the bank rate is really a rate that is available to commercial banks, not individuals. So hopefully you understand how the overnight market works better, and I'll catch you guys in the next one. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.